Are the SP 500 and the Nasdaq 100? We're going to get right into exactly what's happening going on this week and overall expectations based on news. Now, specifically going into news and this week, I want to talk a lot more, a little bit broader scheme, a little bit more down the line than maybe the next 5 days. Now, I will go over what I expect this week. I've gone over that a lot in the last video, but I want to spend a bulk of today's video really going over some of the data and things we've been looking at and kind of have expected since October and November. Before we get into any of that content, I have to ask you to consider doing two things: liking and subscribing. Every single day I make videos for you here on the channel. I'm trying to make the quality better and better as we go also. And when you come here, you know you can expect a non-biased point of view, and that's one thing I try to pride myself on, is being as honest as possible every single day and always giving you the bitter truth, whether you like it or not. Also, Twitter link is down below so you can see my opinions, charts, and different tips and tricks about trading that I'm doing every single day. Let's get into the video. So for today's video, we're going to be going over a few of these charts, but I want to talk a lot about our whiteboard. We haven't been here, and it's been a while, it seems, right? And I do want to talk about a few things here, and we can kind of backtrack if we need to. And when we get in here, I want to discuss specifically where we're at. Now, going back into basically we made this was in early November, early October. Okay, so let's just highlight a few bullet points of what we've looked at, okay? Now, we've known a few things. The biggest things or biggest concerns were going to be going into March and ultimately into that summer season coming up. And that's we have a little bit of a ways to go, but we're going to talk about exactly what is happening right now. So, and it's funny that we have, bullish right there, because we're going to talk about that as well. But this is what we're going to do. So basically, over the past few weeks, months, if you will, specifically 2 months, we've seen inflation data perform better than expected, to say the least, right? So we've seen basically from June to October inflation data, which is going up. I probably shouldn't use, I mean, we can use, rainbow, because honestly, that's what most people that are extremely bullish here believe in: rainbows, unicorns, and a lot of make-believe stuff. So we're just going to erase that real quick. But I just want to highlight what's happening. So basically through October, June through October, summer months, we had nothing but terrible data coming out, right? Just straight up, straight up, straight up. Okay. Now, when we battle back into this through November, basically through now, which we expected, and again, you can go watch those previous videos if you want to when we cover this, we expected better data. Based on what? Based on what Powell has been telling us. And what was Powell saying, and what was his tone back, I believe, November 10th? His tone changed to the sense of, we don't have to worry about unemployment because we can't control it right now, but we need to be looking at data. And that's where these come into play: PPI, PCE, CPI, etc. And when we look at those, the data has performed based on pure numbers good. If we look at the whole number of all those combined of what compiles CPI, that number has dropped from roughly, I believe, 8.7 with highs of 9.2 all the way down to roughly, I believe, 6.5 right now on CPI, which has been really what the retail market's been looking at. Powell and the Fed have said a lot of times that PCE is a little bit more important, but again, we'll talk about that. And really, this order goes, and usually what happens, it's usually CPI, PPI, PCE, but as of lately, it's been CPI, PPI, PCE. Really weird how it's switching up. Worth mentioning. They will also be changing the way that they're factoring in CPI, just so you know. It won't be for the previous 2 years. It'll only be for the current 12 months. I believe that's what they're doing. So it should give you a better report on and a better reading on real, relative inflation right now. So what we're going to look at here specifically, as we zoom in, what has happened that we've expected, okay? And this shouldn't say January, to say February. That's why I crossed it out before. So it should be crossed out, and this should be Feb, right? Because this is our next meeting that we're going to have, right? So we expected a 50 point going into December. Why? Because data was sliding to the better thesis, right? And what's happening with that? We expect data to slide into like a better territory, which was happening, right? And Powell said they want to slow down on hikes. They don't want to stop. They want to slow down right now. And they want to get to the point where they can just stop raising. But we do know that they're not going to cut rates until either early 2024, and now it's leaning towards mid 2024, which that could be terrible. But let's ignore that. If that happens, terminal rate comes up to 4.75 in February. That's not a bad point of view. If we look at where they kind of have their ceiling of the terminal rate and expectations, it's roughly 5 to 5.2% right now. Now, what does 6.6 represent right here? This is where things get a little bit interesting, and I believe this is where they kind of have room for error if they stop raising too soon. And this is the major problem. So right now, I think we're on track perfectly for a 4.75 with a 0.25 hike in February and most likely a 0.25 hike in March. And right now, I think you're at like a 98% chance of getting a February hike. So these are just things to like anticipate. So right now, what is going on? We are fully expecting every CPI report to basically drop by 0.5%, which is ludicrous. We are expecting, and it's priced in now at this point, almost 100%, that a February hike will be a 0.25, which will cut it in half once again. So right now, all the good news, if you will, has been kind of pre-planned, priced in, based on the numbers in front of us, okay? And where do we get more of this information to confirm this thesis? If we come back in and we can look just really quick at NQ, this was the visual that was concerning for me. So if we come in here to NQ really quick, we're going to go to full screen for a second. And I'm going to go off the daily chart to about the 2 hour. And we're just going to show you. So this January 12th right here, this date right here, this is going to show you when we just had our data on CPI. Now, very interesting behavior because all week long we were anticipating good data, good data, good data. I believe Morgan Stanley or JP Morgan came out, had it on Twitter also. They said they expected a 2 to 3% move if we come out with a decent move. Actually, it was about a 1.5 to 2% move. 3% is if we like smashed below 6.4%. And anyways, it came out about 6.5, which was expected. And then core CPI rose. What happened from this? So all into that date, we actually have the upside. And then we stagnate and then do nothing. This is just my personal opinion. We were seeing a lot of short covering. And this goes back to just my viewpoint on looking at volume, looking at new orders coming in, looking at what's happening with indexes, what's happening with equities and how they're moving. I personally believe that that's what we were seeing on a broad market. I'll go into a little bit of a better view here in a second. So that's my viewpoint there. If this was necessarily bullish, I'm going to go a little bit deeper. I think you would have saw more upside, okay? Because in reality, if we come back to roughly, we do have a 2 hour supply here. I do want to highlight it's like a small 2 hour supply, but it's not huge. If we go to something like the 4 hour, as you can see, from this 4.9, as you can see on NQ, there's not a lot of liquidity up into 11.7. For instance, when you break below 11.8 here, you just drop straight down to 4.9. When you break below 11.8 here, you get a quick drop, come back up, another quick drop. Again here, quick drop. So we can see this is an area of illiquidity. Now we have to acknowledge on the smaller time frames, yes, there is a supply there. Won't deny it. But it leads me to be concerned just with how we're moving here and how we're not seeing continuation yet. I fully expected above 11.49. That would be a really strong move, especially with good data from CPI. But we broke down that data and we kind of discovered where the issue was inside of that. When we look at data and it comes back to our whiteboard, it comes to energy. And again, I must have deleted it here, but we have energy and it's the biggest wild card on the market. If there's any possibility that inflation spikes back, it's all dependent on energy. So you have to remember that. And so when we look at energy, that's the biggest question mark. It's so hard to type with this with this mouse. But if you get energy to come in, we're just going to ignore that spoof. I believe it's totally possible that inflation reignites. And the number one thing we're seeing with inflation data right now is, yes, we're seeing some of the data come down, and it's only coming down from that energy sector primarily. Rents are going up, cost of living is going up. Everything across the board is going up except energy. Even your at-home energy bills are going up significantly, one of the biggest factors right now. But unemployment is not rising. So what does this tell us? If we look back at previous, histories of inflation data rising high, what is the common denominator? People start to lose their jobs. It gets very tough. Like if we just take food for thought, any type of recession we've had, I don't like using the 08 as an example, but if we look at what happened during 08, even though it had nothing really to do as far as some of the inflation data that we have now, it's a totally different sector, but it still required people to get hit. We saw unemployment rise. We saw people losing their homes. We saw a lot of pain in the market, really on the side of foreclosures and homes. Now, if we go to the 1970s to where this is the most relatable, that's where you get a better visual or context to what's happening now. You saw unemployment start to spike. Unemployment's going down. From December to January, unemployment is down. You went from 3.6% to 3.5%. This is comical. Now, the Fed does think, and they are pricing in, and they're expecting a 4.5% unemployment read by the end of the year. Could it happen? 100% it could happen. But at the rate of what inflation is doing now, it will not happen. You're going to have to start seeing across the board everything drop. And until that happens, we're not going to see unemployment drop either. Because that's what's going to have to happen. People are going to start having to feel the pain, and then you're going to start seeing people not able to fulfill the overall supply and demand that's out there right now. Because right now, if you are a vendor, or if I'm selling, for instance, eggs, or I'm selling steaks, as a company, if I can continue to sell those at $60 per, think about it. You have no incentive to lower prices. It's the most ridiculous thing that we've ever heard. It's the same thing with energy as we talked about it a few weeks ago. Remember when we were talking about Biden wanting to get everyone to lower their energy output, lower what they're selling everything for? It makes no sense. No one's going to do it in a perfect way. It makes no life. This is a capitalistic market, and it's been like this for years and overall decades. So we need to acknowledge that. So going back in here, NQ, I don't love the chart. I think you have upside to 11.7, 11.8. My personal opinion, I've established shorts for March 17th. That's what I am doing for myself. I think it's a riskier position, but the name of the game for me is to continue to try to scalp any type of upside on some of these equities, because as we jump in here, let's look really quick. As we look at something like Microsoft, look at the volatility we've had. I mean, even with some of the slowdown that we've had on Nasdaq, Microsoft keeps going very strong. As we look at, Apple, what's happening here? Great recovery so far. Really nice. You cannot deny what's happening here. You can go further and further. Nvidia. Now, the argument is that these were getting a little bit harder than the indexes were. Indexes weren't extremely volatile to the downside recently, and these really got hammered. Like Nvidia dropped from basically 180, 186 all the way down to 140 in a matter of 2 weeks, right? And now we're bouncing right back up in the matter of 10 days, right back to 1170. So we're seeing that volatility specifically in equities. So I think the day trading opportunities are there to mitigate any risk that I personally have on my short positions, because they are a little bit more dated. So they're obviously not going to move as volatile as something like a 2-week out or a 3-week out contract. So that's my bread and butter as we speak. I want to make that extremely clear, extremely visible, that that's my plan. That's what I'm doing. Now, when we look at a few of these other things, and this is, again, has to be your cause of concern. We're going to look at the barrel. This is US oil. We're going to look at it on the daily time frame. I want to look at it on a higher time frame so it can't be skewed, and we can't get anyone mad at Tyler. So if we look here at the US oil, this is the barrel, just giving you a visual of where we're at. Okay, first of all, I'm going to come back to this is June 2018 highs, big level there. We also had our highs right here. This was basically our 2021 highs. Yep, about right here, 2021 highs. And we're tracking back up. We can also mention, you can see, you came right back down into a major area here as well. You can go into like the weekly chart and you can see it's very clearly a supply zone or demand, right about here. And you came right down in that area. It's a $10 range. Sorry, not beautiful. You don't love to see it. You can even tighten it up to there if you want. And then you can even tighten it up here on the daily to identify it as a daily supply if you want to go a little bit shorter dated. But of course, weeklies are always going to be the strongest of the supplies. And we're seeing something interesting happening with energy. You do not want to see energy prices, specifically the barrel, go up with the market right now. Because in a reality, what we're looking for with inflation data, we should be seeing oil prices, energy prices dropping. And we all know what happens with oil and energy. It's a lagging indicator. So if we look at something like SPY, and I've done this on the live stream a few times, if we look at SPY, I think energy has been one of the direct indicators on the market, better than DXY, better than anything and everything. If we look here clearly over the past basically year, what's been our data pool, what's been our numbers? So basically going into December 2021, we had that nice little drop all the way down. And then that's kind of where the market topped off at. Once you made that bottom, energy went crazy. You can fast forward really to around January, mid-January, whenever you started seeing the Russia and Ukraine start to escalate. And that's when energy went just bonkers. You went to all-time highs here. But what happens to the stock market during this time? Obviously, it's a counterintuitive measure because that's when inflation starts to rise. As energy rises, so does the cost of everything we do and everything that we're trying to do. And so you see this going berserk. So we see SPY come crashing down, and then guess what happens? Energy drops, SPY pops, and then energy pops back up, and SPY continues to drop. Again, it's important to realize energy is a lagging indicator on the market, okay? So you're going to see energy data come out first, and as energy rises, you're going to see costs rise probably in the latter month after that. So these are things you have to understand when you're looking at these big overall indicators. But now, as of recently, you've seen a little bit of a change. As you continue to make lower lows on energy, specifically if we go into the SPR and our reserves and what's happening here in America, because now we've come to the conclusion that there's been some manipulation on the oil market. Specifically with, are we even buying oil right now? And we're not. We actually tried to fulfill an order to get some of our SPR reserves back up, but it was denied because it was above said price. And if we look here, this is where things start to get interesting. You're actually making these lower lows, as you can see here, but you're seeing SPY kind of chop around following with energy. And this is where things, in my opinion, have to just be where disassociating reality. If oil starts to pop back up, above that, some of these key levels, let's get rid of SPY so you can see. If it gets back above 85 to the $90 region, I think we have to be concerned about what's going to happen with inflation data. Because as we come back to this chart, what Powell continues to say, if they let off the measures of inflation, what could happen if this starts to become entrenched because, we haven't handled this the correct way and they slowed down too soon. So I believe right now the goal is to get to about 4.75, most likely 5% flat on the terminal rate coming in March. I would guarantee that's probably that'd be like my 90%. If I had to say how sure it was, it'd be 90% sure we get to 5% come March. Now, you want to leave room for error just in case inflation spikes back with energy, which I believe is what they're all concerned about right now. And if we look what's happening with China, because right now, who's buying all the oil out of the Iran and the Sauds? Who's buying all that right now? Primarily China. If we look at what happened with the nuclear deal, we don't talk about it anymore. Remember 6 months ago, that's all America could talk about was the nuclear deal and how it's going to fix the oil issue? Well, spoiler alert, the person negotiating that deal was, in fact, Russia and Putin. And guess what happened from that? China is the big winner. So now what's happening is oil is increasingly more expensive for America. They're offering an even bigger discount to their friends in China. And what is China doing with the oil? They are overpricing it and selling it for higher rates instead of discounting it to their own people because the energy demand is just that high. Right now, China is trying to reopen their economy, which is actually one of the more bullish aspects of the market potentially, just based on supply and demand. However, if you look at their COVID data, it gets brutal. It gets disgusting. They've actually just stopped releasing their data, and they released it for the first time in a while, I believe the past 2 weeks. If we look back at what's happening, and I know people here don't like to talk about COVID, but let's just be real about what's happening here. Specifically, this will probably affect the market. I just got to say, China reports, if you don't know, this was their biggest outbreak so far. 60,000 people have died of COVID since early December. Not laughing about the fact of it, I'm laughing that no one else is talking about it, right? We only want to talk about what people want to hear. But what about the side of it that could potentially save us from our own demise? That's my opinion. These are things that I'm viewing. Now, am I saying sell everything, short everything? It's not what I'm saying. I'm saying just watch the underlying factors. Because just like if we go to, SPY, if we look at SPY on the daily, when you've had these moves to the upside, I believe you've had re-entry opportunities. Go back to June, probably our best rally so far. You pushed up, you came back down. You had an entry opportunity, right? Going back even to October on SPY, you had an entry opportunity. Only one you maybe didn't have an opportunity was March when it just went straight up. But those are things to realize right now. I don't believe we're just going to go straight up in a straight line and there will be no turbulence along the way. We have to get a retest. We have to understand what's happening here. And if we just move up in this, wedge type formation, I don't see the potential upside, or I could see the potential demise of the upside very quickly. As we look a little bit further before I let you out of here, the VIX, we look at VIX. A lot of people are asking about this. I know you're going to ask about this on the comments down below. VIX obviously at, it's at 51-week lows, not 52-week lows. This is your 52-week low right here. So you probably break it next week, worth mentioning. VIX extremely, extremely low. Going all the way back through even 2020, this was a very volatile area for it to bounce. A lot of big orders. I believe we had the $6.4 million order coming for, I believe, the 30s for April. Go look at the chain. I posted it in Friday's video also. These are things to visualize and be looking at. When we look at the 10-year yield, we saw the 10-year yield get a little bit of love throughout the day going in on Friday also. Going into TLT, although the market was moving bullish on Friday, guess what happened? TLT was in fact getting rejected, making a lower high. Now, again, it's worth mentioning TLT is still above that 1-year long downtrend. Worth mentioning. I've said this plenty of times. And you're trying to get a bump and run off of this formation, which is incredibly bullish. But if you do start making a lower high here and you start pushing back down, I think you have to be an extreme bear on the U.S. economy. If we look at what the most honest so far analysts, and I know people get mad when I quote Morgan Stanley or JP Morgan, but if we look at a broad market, what banks are the most bullish right now? There are the banks that are at risk of going under. Credit Suisse, HSBC, Deutsche Bank. Those are the banks that are foreign, that are over leveraged heavily and are at risk. And those are the bullish banks in the world, right? But if we look at the banks that are saying that there's downside, that are reducing their overall positions, that have cut the bullish side of their collars on spreads and options, right? Guess what? Those are the American banks right now. You can look what their money's doing. I believe they probably are hedged to the upside. I don't think they're just all the way, short, but it's worth mentioning their viewpoints and where they have been right and where they've been wrong. If we look at last year, I love to use the analogy of what they said last year was the most profitable ETF or sector in the market. They said it in January last year. It was going to be the volatility indexes. If you traded the volatility indexes 4 times every single time to touch $18, you made a lot of money, or $20, right? Made a lot. So I'm just saying this year their expectation is another 20% drop or drawdown on the market. It's my opinion. This is what I'm looking at. Again, I try not to be too bearish or too biased. These are my viewpoints. If we look at just a technical viewpoint of the Nasdaq, it doesn't look bad, guys. It really doesn't. It doesn't look terrible. However, I have to look at the fundamentals, and that's what I try to do. I try to bring the fundamentals and the technicals and have a healthy combination of both. See you tomorrow.